Good morning and welcome to this short tutorial on how to do a question on disposal. This question is taken from the June 2018 ACCN2 paper and it's regarding the selling and buying of fixtures and fittings. First thing you have to remember, when you say the word disposal, this basically means the selling of an asset. So please bear that definition in mind. So let's get straight to this question. So you have here, Matthew is the owner of a number of retail outlets. The following information relates to fixtures and fittings. So you got an extract from the balance at the start of the year with the cost, depreciation to date and net book value. You have some information regarding what's happened throughout the year. So on the 1st of December, he purchased a new asset with a cost of £21,000. So the cost is £21,000 from Shawbaggy Limited. He has used his old fixtures and fittings as a part exchange, so he's given him some old fixtures and fittings to pay for the new ones, and he's been given the allowance of £9,500. So effectively he's got £9,500 for his old fixtures and fittings. The remaining balance, which if the initial cost is £21,000 and he's got £9,500 for the part exchange value, the remaining balance will be £11,500. Is still payable within 60 days. Okay, so there's no money being exchanged whatsoever, so nothing is going through the bank and nothing is coming out of the bank in this situation, because you have, first of all, you have paid for this asset by £9,500 for the part exchange value, and then the remaining as a credit loan, if you like, okay, or a credit term that you've agreed with the supplier. The fixtures and fittings that were part exchange, so now we're talking about a disposal, the fixture and fitting you got rid of, had originally cost £18,000 and have been depreciated by £10,000. So we can conclude from that the old assets were worth £8,000. The net book value of the old assets is £8,000. And then this is the really important part. The depreciation policy is using the reducing balance method, 1/3 of the value. So there's a full year depreciation in the year of acquisition, that's in the year of purchase, but nothing in the year of disposal. So even if you buy it at the last day of the year, you have to charge the full year's depreciation. And disposal, if you dispose of anything in that year, you have no depreciation for that particular asset. So the question is asking you to prepare a fixtures and fittings at cost account, provision and depreciation, and the disposal of a non-current asset. So let's start with the fixtures and fittings at cost. So the fixtures and fittings at cost should be relatively straightforward. The key word here is at cost. So everything that we put into this particular account is only going to be cost values. So we're not going to have net book values, we're not going to have depreciation, we're not going to have how much profit or loss we made on any of the assets. We just have what's our original cost, what we purchased in terms of the cost value, what we got rid of in terms of the cost value. So you should know from your studies that this is an asset account. Okay, so this side increases your asset and this side decreases your asset. So first of all, you can start with a balance brought down. So your balance brought down of £68,000 can go straight in here. Okay. So the date of this is the 30th of the 4th, 2017. You also purchased a new asset. So going back to the question itself, you purchased an asset for £21,000. Now because you can't, and the common mistake students will make, they will just put 21,000 here, and that would be incorrect because you can't put bank here, you can't put disposal here, you can't put your supplier's name here because you don't owe your supplier 21k. you've not paid 21,000 for your bank. So you have to split this according to this question here. You have to split this based on the information you've got. So you've got a part exchange value of 9,500 here. So we'll put that in first. So what do we actually call this? And this is where maybe there's slight confusion about what to call this. We call this disposal, and in brackets I put part X. So you are using your disposal value to pay for your new asset, okay? Because the new assets cost you 21k, so you're using some of the value from your old asset. So the date of this was the 1st of December 2017. And the remaining 11,500 is what you still owe to this supplier here. So the supplier's name would go to here. And again we can put the 1st of the 12th 2017. Now clearly in this question you also got rid of an asset as well. Okay, so the asset you actually got rid of initially cost you £18,000. So because we are only dealing with cost, we would put 18,000 here. Okay, this would be disposal because you have disposed of the asset. We can put the 1st of the 12th 2017. Okay, because it happened on the same date. This actually completes this particular account, so there's nothing else that we need to do with this particular account apart from doing your balance carry down and your balance brought downs. So you should remember from your previous workings how to do this, but I will show you anyway. So you have to add up the highest side first. So you got 68 plus 21, so that adds up to £89,000. So the higher side also goes on both sides. So the difference that you need is 89 take away 18, which according to my calculation is £71,000. This would be called balance carry down. And this happens at the end of the year, so the 30th of April 2018. So you got 30 April 2018. And then the balance brought down is always done the day after, so this will be the 1st of May 2018. And that will be for the same amount of 71,000. Okay, just actually a correction. Because we are doing the account starting from April, the balance brought down is actually should be the 1st of May, which I've just realised, and that should be the case. So it should be the 1st of May, because you can only do the account for this year. You can't really record anything from the previous year. So that completes the cost account here. Okay. Now the next account that you need to deal with is the provision for depreciation account. So some people call this a liability account, which is perfectly fine. And some people call this a reduction of asset account, which is fine as well. So they actually both do the same thing. Because it goes in the SOFP right as a non-current asset, I prefer to call it a reduction of asset, but it doesn't matter. So this side increases your depreciation and this side reduces your depreciation. Okay, so you've already been given a balance on the 30th, again making the same mistake. It will be the 1st of May 2017. The balance brought down is already given to you in the question. So I'm just going to flick back to the question to see what the value is. It's £27,000. Okay, so the asset you got rid of, you also have to dispose of the depreciation. So the disposal of this particular disposal relates to the disposal of depreciation, because you have to get rid of the depreciation relating to the asset you got rid of. Otherwise, you can't just leave it in the account. So it tells you quite clearly that the asset you got rid of has depreciated by £10,000, and that was on the 1st of the 12th 2017. So now the most difficult part, which I think is worth about 3 marks in this particular question, is to try to work out what's the income statement figure here. Okay. Now I'm going to show this as a working. Okay. So the key thing here, to work out what the charge for the year is, this depreciation policy becomes really important. So the depreciation is 33 1/3% using the reducing balance method. So you should note from your studies that the reducing balance method formula is your cost take away your previous depreciation, accumulated depreciation, times the percentage. Effectively, your cost take away depreciation is your net book value times the percentage. Now the cost, if you look at the cost account, which we just did, the cost that we have left is £71,000. So that's the cost. So we have £71,000 is the cost. Now what's the depreciation we have left? Well, the depreciation we have left is 17,000. How is it 17? Well, if you look at your depreciation account, you started with 27, you got rid of 10, and so therefore you have 17,000 of depreciation left. And then you times this by the percentage that you've been given in the question, which is like I said, 33 1/3, which is basically 1/3. So that gives you 54,000 in brackets there, times by percent. Therefore the charge for the year is £18,000. Okay. And that's what we're going to put here. Okay, the income statement figure will always go on this side in the depreciation account because it's an expense. So you would always put it on that side. So again, we're just going to do a carry down and a brought down for this provision for depreciation account. So we start with the highest side here. So you got 27 plus 18, which gives you 45,000. Do that without a calculator. Amazing. 45,000 here. So the balance carry down is going to be 45 take away 10. Definitely don't need a calculator for that. And then you've got your balance brought down 35,000 here. So I'm just going to fill in the dates, make sure I got the correct dates here. So this will be the 1st of May 2018. This will be the 30th of the 4th 2018. And your income statement figure will also be at the end of the year, 30th of the 4th 2018. So that completes this account. And disposal account now becomes fairly easy, because all you will do in this particular account is do your double entries. So wherever you've got a debit anywhere else in a disposal, for example, you've got a debit here, you just put it on the credit side here, and then you look at your cost account as well. Okay, so this account only goes in the income statement. So if you have an income statement on this side, it would be considered to be a loss if the income statement goes on this side, so therefore it would go as an expense. Income statement on this side would be a profit, and therefore it would go as an additional income. So let's have a look at what we have here. So there's never a balance brought down here. There should never be a balance brought down for a disposal account, because it's literally transferred to the income statement for the year and that's it. So let's start with the cost account first. So you already have two entries for disposal. You've got one here, 9,500, and one here for 18,000. So I'm going to do the double entry for them in the disposal account. So I'm going to call this Fixtures and Fittings. I'm going to call this Part X 9,500. I'm going to call this Fixtures and Fittings at cost 18,000. Okay, we can just put the end date here. We don't have to put individual dates, but it's probably better to put the date of that, which is the 1st to the 12th 2017. And then you've also got disposal from your provision from depreciation account, which is just 10,000 debit here, so it's going to go as a credit here. So this will be your provision for depreciation. That can be consistent and put the same date, which will be the 1st to 12th 2017. Now again, you just have to total the highest side up here. So 19,500, 19,500. And the common mistake here is to do a carry down and brought down. Like I said, this account does not need a carry down and brought down, because it's not required to go in the statement of financial position. So the amount, the difference, the income statement figure here, because it's on this side, we know it's a profit of 1,500, which is a difference between 19,500 and 18,000. So that would be at the end of the year. So the common question I get asked for this, and this is a good question to actually demonstrate. I always get the question, we don't know when to use just the income statement, when to use the carry down and brought down. So if you look at this particular account, you've only got the income statement. If you look at the provision for depreciation, you've got the income statement and carry down and brought down. And if you look at the cost account, you only have the carry down and brought down. So I always get the question, how do you know when to use the income statement? How do you know when to use the carry down and brought down? So the carry down and brought down is only used if this particular account goes in the statement of financial position, which it does. Okay, this account does not go in the income statement, so there's no income statement figure here. The provision for depreciation is quite a unique account because it goes in both. Because the income statement figure here goes in the income statement as an expense, and the carry down and brought down goes in the statement of financial position under the heading of non-current assets. So that's why it has both income statement, carry down and brought down. And your disposal account does not go in your statement of financial position, it only goes in your income statement, and in this case it goes as an additional income because it's a profit on disposal, on the sale of a non-current asset, or it could be a loss which may be as an expense. So hopefully that is a kind of a tutorial on how to complete a question on disposal. Okay, thank you for watching. Hopefully it's useful.